we should be expecting to see global growth at a still pretty good pace in 2018, around 3.9% compared to 3.7% in 2017. And the good news within that is that it will be quite broad-based. We're going to see the US and Euro area managing to grow at or above 2%, and we'll also see quite a few of the emerging economy regions that had been doing so badly back in, say, 2016, continuing with their recovery.
We expect a continuation of solid performance from emerging market assets. For the last several years, emerging markets have been driven by emerging market central bank monetary easing. Going forward, we expect a transition in central bank monetary policy, and we expect emerging markets to continue performing well, but to be driven more by global growth rather than high yield. We have two key themes that are driving our overall investment strategy recommendations. The first of which is that we expect continued outperformance from emerging market currencies against a softer US dollar. In terms of emerging market currencies, we are focused on those currencies that are leveraged or geared towards global growth. In Asia, this means that we are positive on Malaysia, Singapore, Taiwan, Thailand, and Korea. In Europe, we are focused on Russia, and in Latin America, we are focused on the currencies of Brazil and Chile. The second key highlight is the continued flattening of the US Treasury yield curve. We do expect short-term interest rates to move higher, but at the same time, we expect long-term interest rates to remain stable or even move lower against a backdrop of low inflation, against a backdrop of continued demand for fixed income products.
The first risk is for major advanced economy central banks' balance sheet expansion to be slowing dramatically by the second half of 2018. This has been something that has been so supportive of markets for the last 2 years, and the ending of it is going to be an uncertain time. It's going to be a time where we'll start to be pricing in risks more aggressively than we were before.
Specifically, in Asia, we expect 6 central banks to keep monetary conditions tight or even tighten them further. We expect a continued increase in interest rates from the Bank of Korea. We expect an increase in interest rates from Malaysia, Taiwan, and Thailand. We expect the Monetary Authority of Singapore to tighten monetary conditions through strengthening of its currency, and we expect China to continue to maintain tight monetary conditions.
The second risk to be watching for is that exports, particularly in Asia, are likely to be weaker than they were in 2017, mainly because the key drivers in 2017 that led to strength across the board were temporary. We're expecting to see a slower pace of growth this year, but the mix will be relatively healthier than it has been in previous years, with even more strength from consumers and from services. That should mean that with even more rapid credit growth in the household sector in China in the coming years, that actually may be a source of strength for others in the region rather than a concern. We're much more aggressive on our expectations for inflation in China in 2018, and the main reason there is that food prices were such a major drag on CPI inflation this year that CPI next year, with more normal food price conditions, should be going quite a bit higher in line with core inflation in China. Another area that we differ from consensus on is that we think it is very premature to be thinking that we will be seeing rate hikes coming from India. In the coming years, there should be an improvement in GDP growth, a rise in inflation, but it should not be to the extent that it forces the RBI to be rushing to tighten policy.